riding a little bit bullish. I think on there was this Monday after Labor Day, was it, that the market just like destroyed everyone? Like you thought it was gonna break out to all-time highs and it just completely reversed. And it caught me off guard. I had a work meeting and I didn't see
Oh,
it. And I was like, when I came back, it's like all red. And I'm like, nah, I can't. So
okay.
from there, I downsized all my positions and just decided to like go light and just kind of monitor the market.
Okay. Well, hopefully today, after this class, you will kind of get a better idea on how to get better entries. So today's class is on getting optimal trade entries so you don't get faked out when prices go up. Well, prices always go up and always goes down, right? So there's something called correction. So I'm gonna teach you on how to spot these corrections, right? Because there's always corrective activity, but your job is to find out where the end of the correction is in order to continue the trend, right? Because it's going to go up. That's the one thing about stocks and futures, everything, all commodities, prices always go up. And so your job is to find when the end of the correction is. So if you're looking at this chart right here, there's always an end of a correction where this is a big drop right here. This is the end of the correction and it continues. So I guess I'll start off class. Thank you for sharing that, Jimmy. I guess I'll start off class by the question that I asked in the Discord. So if you guys see the screen right here, let me know if sometimes I accidentally scan the wrong screen. So if you guys see the screen, you guys see the question, right? Right here. A lot of you guys gave good answers. But for people who are hopping on now, feel free to drop your answers in the comments so I can know that you guys are here. I want this to be a little bit more of an engaging class. Okay, we got one person that says 618 OTE. That is a good one per ICT. 0.5, Lady Brady. Okay. All right. All right. Well, some people who are shy, don't worry about it. I got you. Okay, so Fibonacci level. Well, first I want to explain what it is first, right? So Fibonacci is when we use this for retracement. So, but before you use it, we have to find out which way price is going. So when price is the first thing you have to identify is trend confirmation. Are we in an uptrend or are we in a downtrend? If we are in an uptrend, then the corrective activity is down. If we're in a downtrend, the corrective activity is up. So we look for a manipulation in order to continue the trend. So if this is, let's say this is an uptrend, and let's say that this was, there was candles before this, right? So when price is moving up, the corrective activity is down, and usually it goes down to take out sell side liquidity and is there to take out people who are in long-term contracts to just squeeze them out of their positions where they pick it up. Because when you sell it, when your stop loss gets hit, that means somebody's entering a trade to go long, right? You are liquidity if you are getting taken out of your contract. So you want to know where the liquidity is or you become liquidity, okay? So establishing that this is an uptrend, right? We could clearly see this is a daily chart. This is an uptrend. But the one thing that we have to, that gives us confirmation that it's an uptrend is that we have, what we call it? We have these things. What are these things called when it's at the top? What are these things called when we have highs? Does anybody know what these are called? There's a couple of different ways you can like
Break of structure.
break a structure. And that is when it breaks this, right? When it breaks the high. But what is these highs called? Like there's different names for it. You know,
Higher
there's
high.
higher high, right? Higher highs. What is this? Swing points.
Swing high.
Swing highs, swing lows, swing points, right? So with this indicator, for example, it's just marking out the highs and the lows. It's just letting you know these are the swing highs and swing lows. And when these highs get broken and closed above with a candle, then that is a break of structure. So these swing points, these swing highs, these pivot points, whatever name you want to call them, right? It's just identifying the trend. So when you start recognizing that these reds are going up and up and these greens are going up and up, that is an uptrend. When these reds are down, when these greens are down, that is a downtrend. But on the bigger time frame, so if we go to the weekly, right? You'll see that we're in an uptrend. This is an uptrend, but it may seem like a downtrend on a smaller time frame. That's why we have to use context. And that's why we need to establish, is this a reversal or is this corrective activity? And you do that by using the Fibonacci, okay? So some of the answers that you guys had are correct, right? We had on the Discord, let's see what some people said under homework. So for members, like I have this channel here for homework. We are going to be doing more questions because a lot of times I talk and I might feel like it's a great class and some of you guys do a great job of shouting me out in the channel and saying how good it was. But I want to make sure that everybody who's on there who is shy to talk, who's shy to comment and unmute themselves, that I want to make sure you guys are always following along and you guys are on the same page. So that's why we have in this Discord, we're going to create these where we just created a homework section where we're going to actually engage by asking questions to just keep you always thinking about what you should be thinking, right? I think all the mental stuff is only mental when you don't have a structure and don't have a plan. So anybody you can go, like, I don't know if you guys have been in other communities, they're always like, oh, like, try to desensitize, try to, not let emotions play a factor, but your emotions are signals and they're letting you know either something's right, something's wrong when you're nervous, but why? Why are you nervous, right? It's because you don't have a plan and there's some holes missing. And if you can figure out how to clean up your plan, you have your stop losses, then that removes the emotion. So try to challenge yourself to find out the answers to why you feel the way you do. Okay, that being said, a lot of people said 0.5, 2, then 1, 0.385, 0.5. Okay, so the question was, which key Fibonacci level is often used for an optimal trade entry? Okay, so the correct answer is 0.5, but you can dig deeper. It can go to 625 and it can go to 0.75. Usually it's 618. That's why I kind of wanted to type it incorrectly here. 618 is a level. But the thing that makes it optimal, it has to be at least 0.5. Anything below that is fine, but it has to be 0.5 in order to enter a trade. But 618 does play a factor, and I'll show you guys a couple of examples. But to go back to the trends, right? We have the optimal trade entry, but it has to be establishing the trend. So the trend is up. So how do we know when to come down to? Well, that comes down to Fibonacci level. So when we have our fib, let me just make it 0.5 first, right? I explained it in 2 classes ago, but there's a lot of new members on here right now. So let me just color coordinate this. Let me just make this one green. And let me just make this one red. Oops, maybe 0.5 red too. Okay, let me just color it in. Okay, so when you're entering a trade, you want to get it at an optimal trade entry, which means that you need price to come back to discount. Okay, so we took a couple trades live on Friday and it was super A+, and that's why I wanted to share this with you. But before that, I wanted to explain how I did it. Okay, so if this is an uptrend, it is an uptrend because we are breaking structure, right? This is the Black Rose said it nicely earlier. It's break a structure. So anytime you have a high and there's body closes, it's a break of structure. But if you have a high, if you have a high and it doesn't break structure, this is called a liquidity sweep. This is called liquidity sweep. So these are like double tops, reversals, and then we break structure coming down, and that's letting you know now that the trend is changing on this time frame. Okay, so this is what people see as a head and shoulders. Head and shoulders usually looks like this. We have a liquidity sweep at the top. We break structure coming down, and the sweep here break a structure down, right? Sweep here, break a structure, which ends like break a structure down because we closed body below the low, right? So now we look for lower high to take liquidity. Okay, that is just the basic concept of market structure. But when it closes above it, like right here, for example, then this is a BOS, and this is letting us know that the trend is continuing. This is letting you know trend is reversing, okay? So that's just wanted to break that down for you first. So the reason why I put it here and not here, where you want to put your fibs, right? Sometimes like, how come you didn't put the fib here? Because we had to break a structure here. Right? How come we didn't put it right here? Well, the reason why I put it here is because if we zoom out, right, this is just a small little piece of the uptrend. This is the original break of structure right here on the bigger time frame. That's why you want to use bigger time frame top-down analysis to enter your trades. So anything up here, well, using context, anything up here, if we have liquidity over here, is chasing. And if there's no liquidity here and we're up here, it is also chasing. Why? Because we don't know how long this trend is going to go for. We don't know where the high is going to be. So we have to, once it reaches a certain level, you break the structure, you're not in a trade. You have to wait for price to come down, and those big drops might scare you. You might think the market is reversing. Bad news might scare you, but that is not the case. The case is there's corrective activity. And like I said earlier, our job, since we established that this is an uptrend, is to find out when the correction is going to end. So earlier, someone said it was 618, and that is very true. But anything underneath here is optimal trade entry. And that's why you need multiple confluences in order to get in. So one of your confluences can be, did we sweep liquidity? So we want to find swing lows down here. We swept this. We also had a swing low right here. That is a sweep of liquidity. And just as I mentioned earlier, when we have a change of trend, right? There is some type of sweep. And that's letting you know the trend is changing. But you don't just enter off of a double bottom unless it is a significant key level on a Fibonacci, or if it's into a fair value capital order block. You enter, right, a lot of times after the new low is set. In this case, it's a new high. So we come down, we break out of this high. This is the breaker structure, right? It's letting you know that the trend is changing now. You see how we break this? We have a high, we break this. This is the low, we break this, we break it. And now we look for higher lows. We look for higher lows. So I guess in this situation, would it be here? Would it be this high right here? Breaking out right here? Because we had this is the last swing low. If I go to a smaller time frame, this is the last swing low before we really broke this structure. You could also drag it down here, but sometimes on a daily chart, it may not come all the way down for the daily. So you have to use smaller time frame analysis to try to get in. Let's see, right? We have a swing low right here. We break structure. This takes you to 50%. This also takes you to the pool of liquidity that happens to be right here, okay? So that's just the gist of it. So the answer to you guys is, if you want to find the optimal trade entry, it has to at least be 0.5. It has to at least retrace to discount, right? Everything else could be true. I'll give you an example. This one, you are correct that if I use regular 618 retracement, it tapped into the 618 retracement. Does that make sense, guys? Does that make sense on how market structure is created and then where price changes because of liquidity? This one taps into 618 and you're like, hey, BW, I thought 0.5. I thought you said 0.5 is optimal trade entry. And if you said 0.5, I would have gotten flushed out a little bit. That's why there's context. Is there a pool of liquidity here? Is there a fair value gap here? Well, there is a pool of liquidity, and that is what changed the price, right? So for some of you guys who hear me talk about it all the time, this may sound repetitive, but in order for price to change direction, there needs to be some type of liquidity sweep. So if we look down here, these are internal liquidity sweeps. We have a swing low here on this daily time frame, and we sweep liquidity. Body doesn't close on this time frame because it's fractal, right? Sometimes it may look like it, if I go to the 1 minute, it for sure closed below it. But since this is a daily, it didn't. So this time frame is letting me know that this is a sweep. This is changing direction and pushing up. Okay, so we look for sweeps. We have a swing low here. So this is another example where it kind of breaks down below. But you see buying pressure, buying wicks is letting you know, hey, we're sweeping. And then now we finally made a higher low. And that's where we start utilizing fair value gaps to let us know, is it holding? Are we creating this, establishing this higher low? And inside this area, we look for actionable signals. What is an actionable signal? Well, it's these types of candles. It's like a 2-2 reversal. It's like a morning star. But these actionable signals at support levels, when we're establishing that we're in an uptrend and there is liquidity being swept, that's letting you know we're continuing. Okay. But going back, I don't want to overload you with a bunch of different new terminology. I just want to go simplify it again. There is a 618, but again, why does this happen every time? Does it always dig down this low? On Friday, we were in a trade on, we had NQ open on the left side, ES open on the left side. ES swept the 618 level, but NQ did not. And we were waiting for NQ to come down a little bit lower, but ES already did the job. So we reversed. But this was December 22. So this is whatchamacallit, 20 to 22. This is a long time ago, but you see this concept where we come down, hit 618, and then continue at least 50%, right? So let me give you an example of these charts. Can you guys tell me, looking at these charts, do they not all look similar? Type in the chat. They look similar, right? They look similar. But if you guys look real closely, look real closely right here. What does this say right here? You guys see this right here? The change interval? What does it say? 4 hour? What does this one say? 15 minutes? What's this one say? 1 minute. These are 3 different time frames of the same ticker within the same month. Why does it look similar? It's because optimal trade entry happens on every single time frame. Okay. This is just a fib inside of a fib inside of a fib. Look at this. A fib inside of a fib inside of a fib. This is all the same thing. I wanted to share it with you like this so you guys get some context. Okay. This is more recent. That was 2 years ago. I showed you that optimal trade entry 2 years ago. Okay. I want to use real-time data now. And if you trade with me on Fridays, we're doing it live, right? We're looking at the trades live. But I wanted to show you now how this past week came out. I think Jimmy was mentioning earlier how he entered and we just had the biggest dump of all time. That is true. We had the biggest dump of all time. Okay. We came, we swept some type of liquidity, or we entered some type of fair value gap that was support. And those fair value gaps that hold or somewhere, where's the fair value gaps? There's fair value gaps down here that was holding, right? Maybe this is the last fair value gap on the ground. The last fair value gap on the ground. Okay. So whatever the reason is, we dumped, we swept some type of liquidity, and then we broke structure. And the only reason, the only way you start using the Fibonacci is when we break bigger time frame structures. Meaning, I mean, you could use it on any time frame, but if you want to get a daily bias in order to trade with the trend, then it has to be 4 hour, daily, weekly to trade with the trend. You could always go against the trend, right? I think we traded, no, we did trade longs, but you could trade shorts on a smaller time frame, even though we are in an uptrend, because you could be trading the corrective activity, or you could be trading the trend by waiting for the correction and then capitalizing on the discount, right? So here's an example where we break structure. Actually, let me use the other chart. Where's the other chart right here? Let's go to the other chart. This is cleaner. Okay, so let's go to the 4 hour. This is MNQ, right? So it's a little different, but it's the same. we have well, the reason why I got this first one, right? I wanted to show you why I had the red zone, right? We have a daily fair value gap here. So we just know that fair value gaps is liquidity, just like swing highs, pivot points are liquidity. Fair value gaps are liquidity. Okay, so price likes to gravitate towards liquidity. And after liquidity is hit, it's up to us to figure out now, does it want to continue? Does it want to, and if it does continue, all right, let's say we push up. If it breaks heavy over fair value gap, this is called displacement. But we're not fooled if it stops here, because for all we know, now this can be a trend line break to the downside, and it could be a head and shoulders. That's why it's important for big candles to happen and for us to close heavy above fair value gaps in order for that now to be used as resistance. Okay, so we need big candles to displace. Displacing again means when we rip through highs, and it ensures that there is a break of structure. Okay, ensures a break. If it's like this, where we currently are at, this could just be called a manipulation. This is a weak break of structure, but this is still a break of structure because we have a body close above. Okay, so but wanting to go to where we were, let's go to replays. Where's the replay? So when we come up here, right? Did we sweep? Did we sweep swing high? So when we sweep swing high on a 4 hour, like I was mentioning, 4 hour, daily, weekly, if we sweep, we wait for big candles. And when big candles happen, we displace down, we break market structure. This is a new break of structure, but the opposite way. So break of structure. This is also break of structure, but this is a bullish break of structure because we have a body close up. Now we have a body close down. And when we establish that price is dropping now, this is a downtrend, right? On a smaller time frame than weekly. The weekly is bullish, but the 4 hour is bearish. So now that we established that we have a high, is this an optimal trade entry right here? It really depends. It really depends because yeah, our goal is to get to the fair value gap. So this could be, oh, we bounced here and we can go here. All right, that's a possibility, but let's just imagine this is a 1 minute, right? Can we do that? Can we get here and potentially get to our target, which is the fair value gap? Right, we're holding support, actionable signal. Can we just go? We did have a break of structure right here. So just for this example, since from what I've taught, if you guys want to comment in the chat, is this an optimal trade entry with the break of structure being right here? If so, where would you put the Fibonacci? Anybody want to put in the chat why this is not or is a good area for us to bounce and hit our target, which is fair value gaps? Because again, fair value gaps is liquidity, and price likes to move towards fair value gaps. As you can see, this was a fair value gap. Price like to move towards it, and then what it does there is react. So the recent swing high and low since we touched the fair value gap. So recent swing high and swing low. It could be the OTE of the flip zone that caused a breakout, but it's not OTE of the whole leg. It's not OTE of the whole leg graph, right? I mean, you could use it maybe here. There's really no swing lows here, right? Where's the swing low? This is the swing low, potentially. Right? Is that OTE? That's why I asked in the chat, multiple choice question. Is it let's turn it all on, right? That's the 382. It touched the 382. It touched the, we don't need that one. And we had what, the 786. Okay, so by looking at it, I asked, was the 385? Purposely put a wrong number. 0.5, 65, 0.75. Like,
what if you just do the super small one that just happened? That swing low to swing high. No, not that one. Go a little bit to the right. like right where we hit the fair value gap.
This one?
Nope, nope, on the right-hand side, the right, like the most recent, yeah, that one. And then now go a little bit lower.
This is the lowest.
No,
one.
no, put your one, I mean, move your one to the
Oh.
low. Yeah. And then I'll stretch it. So that looks optimal to me.
But the reason why I drew the fib is because of this. You see that?
Oh, got it. Okay.
Where is the break of structure right here? There wasn't.
I just want to OTE. No, I'm kidding.
Yeah, no, I like that you're actually asking because maybe some people are thinking the same thing, right? We have a break of structure. And let me give you an example from the last one, right? Where's the other tab right here? All right. From this one right here, where do we have that? Was it this one? Where do we have that balance? Oh, was it on the day? It was the daily. Oops. Right. It was the reason why is that we had this, remember on the bigger time frame, this is where the weekly one started. So we had a BOS. I mean, you could do the other way, right? I like that you're experimenting because sometimes you could, right? Because it's discretionary. But the BOS, you want to use a swing low from below the BOS. So wherever the major BOS is, you gotta use the one at the bottom, right? So that's why it gives you the optimal trade entry. So anything in here is where you could start loading up on swings, because there's you're already so deep in, right? That let's say you put your stop loss here, you lose. That's fine. But if you entered,
So wait a minute, say that one more
here,
time.
sorry, this thing is just too messy. Hold on, let me make it 0.5. Okay.
So you're saying anytime I see a BOS,
Anytime you want the BOS, a break of structure. This is the swing high in the uptrend. There's a swing high. So this is like a swing high, this is a swing high, this is a swing high. But you always want to take the fib from below the break of structure, a swing low from below the break of structure, and taking it to the high. Once we establish there's a high and we start making lower highs, then that's when you know that's the high. You don't just grab it while it's going up. You have to let it establish a high and then get lower in order to draw this range. Does that make sense? So as this is building, let's go replay. All right. You can't create the high yet because it hasn't established that there's an end yet. It's gonna keep going, right? It's going to keep going. And until we get a high and then a lower high, a real lower high. So we get a real lower high by what? A market structure shift. This is going mad slow. Hold on. Let me just let me fast forward this even more. All right. We have to establish a lower high like this. We had a market structure shift here because we have a break of structure to the downside. Right. These are all break of structures to the upside, higher lows, higher lows, higher lows, and this is low. Now we established that we finally have a lower low. So now we're looking for a lower high first. All right, we're not making any more highs. That's the new high right there, right? We have a new high right here. So this is a high, low, now we have a lower high. So now we know that this is, now we can draw the fib. You need all this to happen in order. So a breaker structure up, this trend up, and a displacement. Remember, displacement is when we rip through heavy and breaking the structure, not just a little bit, not even like this is a little bit, right? This is a little bit. It's not a sweep. This is actually, we're actually having a lot of meat on this bone. So there's a lot of meat on this bone right here. So this is the market structure shift. So this BOS isn't just a BOS now. This is a BOS market structure shift. Okay, so now we have a high. So now if you're looking to long, you wait for price to come in anywhere into this discount and you look left. You have two eyes, right? You want to look left. You look left if there's any fair value gaps. Is there any pool of liquidity here that we want to take out in order to continue this trend up? So you look over here. You look over here. Okay, do we have any liquidity here, right? We have liquidity here. This is kind of a swing low. We have also lows here, right? We have a swing low pool liquidity. It doesn't have to hit every single one, but this is letting you know that this is where you want to start getting longs. You don't want to get any longs up here, because if you're going long up here, any pullback will kill you. Any pullback, and you want to put your stop losses below swing lows. So I'm gonna put my stop loss here. This risk to reward ratio sucks. So in order to have a better risk to reward ratio, you want to have structure built, because this creates a pool of liquidity to the upside, just like this is a pool of liquidity to the downside. Price wants to fill and sweep liquidity. So now we're creating liquidity up here. It's better to wait for price to come down so you can sweep liquidity like this, and your stop loss would be swing lows. It would be like right here, right? Swing lows, swing lows. You try to look for swing lows. So it gives you a better risk to reward ratio, right? And this is just an example on the daily. This works on the 1 minute too. It works on the 15 seconds too. So I'm just giving you the overall picture on how to use it. But this daily chart is just very clear for me to explain it right now. So as price comes down, we touch that 0.5. You see how people scalp it. And do we sweep any type of liquidity down here? Do we hit any fair value gaps down here? We want to wait, right? So look at that. So now it taps us into our trade. It swept that liquidity that I put right here. And you see now price can now move in your favor and then you can move your stop loss up to continue the trend. All right, you guys see that? So you don't want to chase anything until it comes back down to discount. And anybody will always tell you that, right? You buy the dip, buy the dip. This is the dip. This is not a reversal. It is a dip into discount. Okay? And now we hit our target and we're done, right? Perfect. Okay. So now we want to fast forward to where we are now. Fast forward to where we are now, going to look at the other chart right here. Just to look at this, we had our breaker structure all the way up here. So what do? Right, it's supposed to be usually a swing low. So you want to wait. Now we established that we made a lower high. Now we want to look. Do we have any fair value gaps down here? Because remember, fair value gaps are liquidity. Do we have any relative equal lows, liquidity, swing lows right here, right? So there's none really right here, but you could scalp it right here. So, but just to mark out, we want fair value gaps to be filled. And that's why if fair value gaps are below 0.5, then that's where I put my 618. But anything under 0.5 is where you start to look. And sometimes you might put it right there. If it's like extremely bullish situation, you might just put it at the 0.5, your limit buy, your stop loss below here. But because fair value gap's down here and there's another fair value gap down here, it could potentially dip. But anything up here, if we decide like, hey, this looks like a bull flag, it could rip. You know, it's discretionary, but your stop loss would have to be tight, right? You could do this. You could be like, oh, this is a bull flag. I want to enter when we tap this fair value gap. I'll put my stop loss below this swing low right here, possibly target right here. Sometimes people do that, and sometimes this is a good risk to reward ratio. But if you can see right here, right, it goes against you. It goes against you. You know why? Because this is not optimal trade entry. It's not optimal trade entry. I mean, it could go up, and this is not a bad risk to reward. So if you lose this, like, you know, you could still survive the game because you had 3 to 1. If you trade this 3 times and it works out once and you lost 3 times, you're break even. Okay. But this is not optimal trade entry. 0.5 is optimal trade entry. And if there's fair value gap down here, this could be a little bit lower. So let's say I want to have my starter position right here and my stop loss below the fair value gap that created it. Target is now all this liquidity that's being built. All this is liquidity is being built. So when you see this slow choppiness and we see a quick dump, don't think short. Think like, how can I go long? How can I go long? So let's say this is your first starter position. And if it taps in a little bit lower, this is my second starter position or my second position. Your goals are always to try to target the swing high, swing lows, right? Let's just do, for example, like if it taps there, right? Let's just do the 0.5. All right, this is 6. Oops. Let's just do the 0.5, for example, right? Because they could dig a little bit deeper. Like it digged a little bit deeper. But now you're entered, and the risk to reward is a lot better than anything up here because it's not optimal. Okay, so let's look at what happens to price. It ends up going to fill fair value gap. Ends up to go fill fair value gap. Okay, that is entering using the optimal trade entry strategy. And if you entered on 0.5, there was a little bit of scare. And that's what happened actually on Friday. I entered a trade and it pulled back and that almost took me out. But if you guys trusted your system and have a good risk to reward ratio, it ended up working out. And the people who are on the live with me, some of y'all passed refunded in one day. That's amazing, you know. But I'm not trying to make everybody FOMO. Not everybody's gonna pass in one day, especially with size. I don't know how much of the size one of the members put on in that trade, because I think I only made like $600-700 or something. I think that person made like 3K. So that means it probably traded 3 NQs. I was trading 5 micros, right? So it's really up to you. But if you have a system, you would be able to last the game a lot longer. Okay. And this was an example on the 4-hour. On the 4-hour. And this is using an optimal trade entry to get in, right? So let's see what happens after that, right? I showed you those 3 different charts, but we're going to look at it piece by piece. So after we hit our target, did we make a lower high? Did we establish now that we made a lower high? Did we break structure? Did we break structure right here? So what do we do when that happens? Look for optimal trade entries. We look for optimal trade entries again.
Wait, repeat that one more time.
Okay.
What did you just do?
Well, in order to draw the fib, what do we need?
We need a lower high. No, a higher high, right?
We need this.
Okay, so I have a break of structure. Got it.
Okay.
That's one.
And then what do we need? We need, after we make a high, we establish that we make a lower high.
A lower high.
So that's letting me know, okay, that's giving me now a market structure. Check 1 and check 2.
But I don't have a market structure shift yet. I'm anticipating one, right? Because I have 1 and 2, right?
Yes. So there's no trade.
Okay.
There's no trade.
Okay, thank you.
Okay. So, but what we can try to anticipate, I mean, there's no trade on this time frame. Maybe there's a trade on a 15 seconds, but on this time frame, there's no trade. There's no fair value gap here that we're rejecting. There is some type of liquidity sweep here, though, right? We have a relative equal highs, and we swept it, so that could be your thing. And
No, that's fine. No, so basically, right now, patience is key, right?
Patience is key, but
Okay.
now you could try to anticipate where price wants to go. Where does price look like it wants to go? Do we have pool of liquidity right here? We do. Do we have like fair value gaps here? We do. So some people would like to short it to the fair value gap. Sometimes you could do that. Sometimes people like to wait for it to touch the fair value gap, which is the optimal trade entry. But we wait, we watch, we observe, right? We observe, where does price want to go? Boom. That just happened, right? We just showed it what happened over here. We had a break of structure, and then we established that we made a lower high. So we created that range, and what did price want to do? It wanted to go to rebalance. And remember what I said about corrective activity. Our goal is to wait and try to look left, look on this side, and anticipate where the correction will end. And by finding where the correction would end, it will give us a better risk to reward for your trade. So, oops, go into the 15 minutes again. We can anticipate where price wants to go, and we look for actionable signals. Okay, but since we took out the target on a bigger time frame, right? You don't want to just be like, all right, we're gonna bounce and just go rip all the way up, because especially when we have targets down here with a gap fill. But this is a good way to day trade, and this is day trading the trend, right? Higher low, higher low, higher low. Okay, this is just a liquidity sweep. This is liquidity sweep. Remember, liquidity sweeps are just changing direction, changing price direction. This is a sweep. So we look for sweeps to continue up. We look for higher lows. We look for bullish fair value gaps to keep the trend going. And we look for swing highs to be our targets. This could be our target right here. And once we break structure and we establish lower high, now we create this fib and we can trade back to corrective activity or wait for optimal trade entry to enter. Okay. It is overextended a little bit. So you don't want to just keep longing all the way up, right? Because you have to zoom out. You know, we got to zoom out and be like, hey, could we go a little bit lower? Yeah, we can. But this is a good way to just snipe this entry, get your funded account, and you know, after that, it's up to you to manage it. Okay, so there's this one, and I think we had was this the turtle soup that we traded? Which one we traded? We traded this, and then we traded a unicorn at the end of the day, right? So let's just try to fast forward. Boom. That was the end of the day, huh? Where was that unicorn that? Oh, this is the unicorn that we traded. Okay, I think okay. So that's the 15 minutes. Let's try to go again. Like we'll find it on the 1 minute, right? What was that 1 minute one? Okay, so this is the 1 minute now. Okay, let's clear up this chart. Move drawings. Okay. So the trade that we took last, which was incredible. All right, is when we have the 1 minute now. We had a break of structure here. This is swing high. Break of structure. And now after we establish a lower high, we take our fib and we try to anticipate where price wants to go. And with NQ, did we hit the 0.5? Yes. So again, what is their strategy? We could enter in the 0.5 and we have fair value gaps down here. So you want to kind of give it a little bit of breathing room and then target the swing highs because there's corrective activity. Our goal again, once again, is to time where the correction ends. Okay. And then this is where we entered. It got a little scary, but it ended up working out. And that is how 3 different time frames using the same exact strategy. If you guys can just do this and try to figure it out on recognizing break of structure, liquidity sweeps, discount, you can find yourself having a little bit more of an easy trading, you know, to improve your trading strategies and have a little bit less stress. And usually around this area, what we want to look is, remember, look left. Is there any type of fair value gaps? There was one right here. Okay. Was there any liquidity sweeps? There was one right here. Okay. So when price breaks up, where does it look like it want to go? It wants to go to target swing highs. And after that, it really depends. If it displaces up, that is a break of structure now. If not, then this is going to establish lower highs. But this is the internal high you want to go for. And if you could just do that, I think that you will be in good shape. Any questions?
I have a question. So do you think it's like one, I could set a entry limit, you know, like a limit order right at that 0.5. But do you think it's best to wait for a retest of the 0.5 to see maybe if it goes a little bit lower or something, or takes out that liquidity? Or do you think you can just take it right off the rip and then just deal with the pullback?
It depends, right? That's why there's context. You could put it at the 0.5. There's a lot of times where it does come down and double bottom at fair value gaps. We're looking for a soup. Okay. And if you look over here, remember what a soup is, right? A soup is a liquidity sweep inside fair value gap. But let's go to right here. Yeah, we tap into fair value gap. We tap it in. But do we sweep any liquidity over here? No, right? We didn't really sweep this last swing low. But it doesn't have to swing this last swing low, but we need a liquidity sweep. So they're like, we didn't sweep anything yet. So that's why price came out and swept it one more time. But if there was liquidity here, then no. But since there wasn't, it tapped in twice. You see that?
Oh, so wait a minute. Is that what that book is about? The Turtle Soup Trader? That's all they want them to do is that?
Well, turtle soup is only sweeping liquidity in fair value gap in discount. That's it. That's just simplified. You could like, there's probably gonna be like, oh, we gotta look for like all these different things, and like, if you just understand that, then your brain won't hurt, right? A lot of people are still new to trading, and break a structure already is hard enough for them. So break
Okay.
a structure is a close above swing high. And then a liquidity sweep is when we get rejections like double bottom, but it has to sweep it. That is a liquidity sweep. So that changes direction. Okay. And a liquidity sweep inside a fair value gap is a turtle soup, because this is internal sweep taking you to external draw. Internal sweep, because this is the low, but it's an internal sweep, because if it was a real sweep, it would come all the way down and touch this. But it's not a real sweep. It's an internal sweep. So an internal sweep, fair value gap, internal take you to external draw is a turtle soup. Okay.
Got it. You know what messed me up is I kept waiting for 618, 618.
We
I'm like,
waited
oh,
for
I
the
love 618.
That's what
And it
messed
just
us up.
never did it. It
Yeah,
never
that's what
did
messed
it.
us up. That's why I just took this. I just took it because we saw the sweep, right? Or I took it on ES, but you know, where's ES? Yeah, this is ES. All right, so on ES, 1 minute, it did hit the 618. Okay. Where was it? It went lower. That's where it went. ES went a little bit lower on the 618. Am I tripping? But yeah, we took it on ES, and then that was when I created that cup and handle. Remember, we had the sweep, break a structure,
And there goes the bull flag. Yep.
break a structure. So when you have a break a structure, what do we do, guys? What was it here? Where do we have it? Tripping. Where did I have it? It was like right here, huh? It was on a smaller time frame. I think I was trading. Were we trading the smaller time frame right here? Remember, I
I
was
think
like,
we were both trading the 1 minute, but for some reason we both had the same time frame up. And then we said, oh, it's SMT divergence. And you said, oh, ES hit the 618, so I'm gonna take it. And NQ doesn't have to do it, but this is like a good sign or whatever. Like you could still take it. It
yeah, I
was
was like,
something
this
like
is a
that.
bull. Yeah, I was like, this is a bull flag, and I was like, I'm not gonna take it until it comes down. It was dancing up here for a long time. Remember?
Yep.
I was like, if it leaves without me, but I'm not gonna enter it till it touches this fair value gap. And I think I took it from this internal.
Yeah. You did
There
like
was a break of
two. You
structure
did
right
two
here. Okay,
entries.
I took it right here because it was a break of structure on the smaller time frame right here, BOS. So there was a smaller time frame. There was a BOS, swing low, break of structure, and I knew it was late in the day, and I put my stop loss right here. So I think I entered like right here. It was like right here, right? And then I put my target to like the fair value gap. And then I put my stop loss just below this candle. And it almost took me out, remember? And it just ripped. And it just kept going. But that was the trade because we're utilizing discount. And obviously, like I said, it's discretionary. You could use it here. Oh yeah, I put it right here, I think. And it tapped into the 50% right here. And then it almost took me out, and it went. And sometimes, like I said, if it takes you out, it takes you out. But it's better risk to reward. It's still a 3-to-1 risk to reward ratio right here. So it's a safe trade. Okay. And if it takes you out, it takes you out. But you're not chasing anything up here. Sometimes you get so much FOMO. You're like, oh, I see a fair value gap. It's going, but it's not optimal. There's no type of retracement yet. This is the retracement. This is the manipulation in order to get into the trade. You need a manipulation, and that's when you get in. Okay. So yeah, that's what I wanted to cover today. That's an optimal trade entry. 0.5 is the minimum. And that was the correct answer. So, oh shit, my computer's gonna die. All right, any other questions? I think that wraps today's class up. Hopefully you guys learned something today. If you guys like this or have any questions, feel free to tag me in the all access, or if you're a member already, we have that homework section. You guys can tag me. I want to see your charts. I want to help you guys with this, because once you figure this out, then you realize that, like, dang, I've been trading with blinders on this whole time. Okay. So without any more, let me just end stop the recording right here.